Welcome back to Intrinsic Insights. Today we are stripping away the marketing fluff to look at the raw intrinsic value of B2Gold, fresh off their Q4 and full year 2025 results. When evaluating a mining company, the first rule of survival and profitability is the margin of safety. You don't look at the gold price, you look at the balance sheet. In 2025, B2Gold generated a record $3.06 billion in revenue on over 927,000 ounces of gold sold. But revenue is a vanity metric. What matters is cash. B2Gold produced an annual operating cash flow of $940 million before working capital adjustments. Liquidity is what prevents a miner from being diluted into oblivion during a downturn. As of December 31st, 2025, B2Gold is sitting on $380 million in cash and cash equivalents. They also have $650 million available under a revolving credit facility, giving them a massive liquidity buffer. A disciplined investor doesn't just buy the good news, they look for the pain. And for B2Gold, the pain is coming in 2026. For 2025, their consolidated all-in sustaining costs came in at $1,584 per ounce sold, excluding pre-commercial production from the Goose Mine. In a $3,000 plus gold environment, that is a healthy margin, but their 2026 guidance is a stark reality check. B2Gold is forecasting a drop in consolidated production to between 820,000 and 970,000 ounces. More importantly, 2026 all-in sustaining costs are projected to skyrocket to between $2,400 and $2,580 per ounce sold. Why the massive jump? Capital allocation. They are heavily investing in deferred stripping at the Fekola Mine in Mali and funding the ramp-up year at the Goose Mine in Canada. A contrarian investor looks at this and asks, is the market punishing the stock for this temporary capital expenditure? If a company takes the pain today to extend the life of mine tomorrow, that is a classic setup for future cash flow generation. You cannot analyze B2Gold without addressing jurisdictional risk. You get a discount for operating in tough zip codes, but you have to make sure the geology pays for the geography. The Fekola Complex in Mali is B2Gold's cash cow. It produced over 530,000 ounces in 2025. However, Mali has seen significant political shifts and a transition from the 2012 Mining Code to the 2023 Mining Code. Here are the facts. B2Gold recently reached a settlement with the state of Mali regarding income tax and customs assessments, giving the Fekola Complex a clean slate. This allows the state to issue exploitation permits for Fekola Regional, which is expected to contribute an average of 180,000 ounces of additional annual gold production from 2026 through 2030. The geological upside is proven, but investors must continually weigh the geopolitical discount applied to West African assets. Finally, how is management treating the owners, the shareholders? Are they empire building or are they returning capital? In 2025, B2Gold utilized their normal course issuer bid to repurchase 2 million shares for $10 million. And after year-end, they repurchased a further 5 million shares for $24 million. They also declared a Q1 2026 dividend of 2 cents per share, yielding an expected 8 cents annualized. It shows a willingness to shrink the share count when the equity is deemed cheap, a trait highly valued by value investors. B2Gold in 2026 is a story of deferred gratification. You have a fortress balance sheet, a massive cash-generating asset in a high-risk jurisdiction, and a year of heavy capital expenditure ahead that will severely compress margins in the short term. The intrinsic value play here depends on your belief in management's ability to execute the Goose Mine ramp-up and navigate Malian politics. If you found this forensic breakdown valuable, hit the like button and make sure you comment which companies you'd like to see next. For more unbiased deep dives into the real numbers driving the markets, subscribe to Intrinsic Insights. We'll see you in the next one.